The power of compound interest, building wealth over time. While money doesn't grow on trees, it can indeed grow if invested wisely. This concept is based on the power of compound interest. Compound interest is the addition of interest to the initial sum of money, which continually grows over time. It can significantly impact your wealth-building process, allowing your money to grow faster and larger. In this video, we'll explore the power of compound interest and how it helps in building wealth over time. Before moving forward, if you are new to our channel, don't forget to like and subscribe to our channel for future interesting videos. The fundamentals of compound interest. Picture compound interest as a snowball rolling downhill, collecting more snow and growing bigger as it descends. Similarly, your initial investment is the snowball, and the snow it gathers represents the interest. So imagine you start with a $1,000 investment in a savings account with an annual interest rate of 5%. At the end of the first year, you'd have earned $50 in interest, bringing your total to $1,050. But here's where it gets interesting. In the second year, you aren't just earning interest on your initial $1,000, but also on that extra $50 you accumulated. So your interest in the second year is $52.50, 5% of $1,050, not just $50. This process keeps repeating, and with each passing year, your money grows more substantially. The magic of compounding over time. Think of compound interest as a secret recipe that takes time to fully develop its flavors, with time being the key ingredient that enhances its magic. The most exciting aspect of compound interest is the exponential growth that unfolds as time progresses. The more time you give your money to expand through compound interest, the more it multiplies, increasing at a faster pace with each passing year. Let's take a closer look at how time's magic wand waves over compound interest. Consider you start investing in your early 20s instead of waiting until your 40s. By the time you reach your 60s, even if you're investing the same amount of money as someone who started later, your wealth accumulation would be significantly higher. This is the consequence of compound interest working its charm over an extended period. Imagine compound interest as a skilled artist, and time as the canvas on which it creates its masterpiece. The artist begins with a few strokes, your initial investment, and over time, each additional layer of paint, the interest, adds depth, detail, and value to the masterpiece. The more time the artist spends on the canvas, the richer and more valuable the final work becomes. The longer you leave your money to grow through compound interest, the grander the financial masterpiece you'll be left with. In a nutshell, compound interest and time share a beautiful dance where each step represents your increasing wealth. The rhythm of this dance accelerates with each passing year, and the longer they dance, the more wealth you accumulate. Time, in this case, is indeed money. Therefore, it's critical to step onto the investment dance floor as early as possible and let the enchanting ballet of compound interest lead you towards building your wealth. Understanding the rule of 72. Have you ever wondered how long it would take for your investment to double? The rule of 72 provides a quick and easy solution. By dividing 72 by the annual rate of return, you get an approximate number of years required for your investment to double. This rule is a powerful tool to understand the timeline of your investment growth. Let's make it even simpler with an example. Suppose the annual interest rate on your investment is 6%. By applying the rule of 72, you can determine how long it will take for your investment to double. Do the math. 72 divided by 6 equals 12. This means that with a 6% interest rate, it would take approximately 12 years for your investment to double in value. This magical rule gives investors a unique perspective on the power of compound interest over time. By understanding the rule of 72, you can set realistic expectations for your investment growth and plan accordingly. It's important to remember that this rule is based on an approximation and might not account for market fluctuations or changes in interest rates. However, it is a great starting point for those new to investing, helping you get a rough estimate of the power and potential of compound interest. In the end, the rule of 72 is a testament to the remarkable synergy of time and compound interest. It provides a straightforward way to visualize how your investment can grow over time, further emphasizing the importance of investing early and staying consistent. So use this handy rule to navigate your investment journey and let the power of compound interest work its magic on your wealth. Utilizing compound interest in investing. In the realm of investing, compound interest is akin to a trusted ally, helping you advance towards your financial goals. Picture this: a vast portion of investments, be it stocks, bonds, or mutual funds, generate returns that, when reinvested, further contribute to your earnings. This principle of reinvesting earnings is where compound interest swings into action, magnifying the potential growth of your investments. Take, for instance, you invest in a mutual fund that generates an annual return of 7%. Instead of withdrawing your gains at the end of each year, you decide to leave them invested. By doing this, you allow the interest to earn interest. Your investment snowball starts rolling and growing larger as it moves down the investment slope. This is the potent power of compounding, turning your investment into a money multiplying machine. Through this process, compound interest not only boosts the value of your investments, but also fast-tracks your wealth accumulation journey. The continual reinvestment of earnings can turn the smallest trickles of profit into a roaring river of returns over time. It's like planting a tiny seed that, with consistent nurturing and patience, grows into a fruitful tree, providing bountiful returns. This is the essence of investing with compound interest: starting small, being patient, and watching your wealth grow over time. Building wealth through consistent investing. Maintaining a steady pace in your investment journey is like following the rhythm of a well-composed symphony. Each note, or in this case, each investment, contributes to the creation of a beautiful, harmonious whole. Building wealth isn't necessarily about making big, risky moves. Rather, it's about regular, consistent investments that accumulate and multiply over time, orchestrated by the power of compound interest. Imagine a stream that starts as a trickle. Initially, the water flow might seem insignificant. However, as the stream continues to flow consistently, it gathers volume and strength. Similarly, even a small, consistent investment can build up to become a significant amount over the years. Consider the practice of regular investing as the heartbeat of your financial health. Just as a steady heartbeat is crucial to sustaining life, consistent investing is vital for nurturing your wealth. With each investment pulse, your wealth gets a boost. And over time, these regular contributions can add up to a substantial sum. Investing consistently doesn't merely build your wealth, it also instills financial discipline. This approach reduces the temptation of timing the market, a strategy that can be risky and often unsuccessful. Instead, it encourages you to invest at regular intervals, irrespective of the market conditions, thereby spreading your investments across different market phases. In essence, consistent investing is a journey, not a sprint. It's about having the patience and discipline to keep investing and let compound interest work its magic. So set your investment tempo, follow it faithfully, and watch the crescendo of your wealth reach new heights. Just remember, in the symphony of investing, consistency is the melody that leads to wealth accumulation. Navigating the risks and rewards. Just like any powerful force, compound interest can be a double-edged sword. When investing, it serves as a growth engine, accelerating your wealth accumulation. However, when it comes to borrowing, the tables turn and compound interest can be your foe. In this scenario, you're charged interest on the interest you owe, leading to your debt snowballing over time. Hence, it's crucial to use this powerful tool judiciously, ensuring it works for you and not against you. Investing inherently involves some degree of risk, and it's no different when compound interest is in play. It's like sailing the high seas. The prospect of discovering new riches is thrilling, but one must also be prepared for the stormy weather. To navigate these unpredictable waters successfully, you must balance between risk and reward. One effective strategy is diversification, or spreading your investments across a variety of assets. This approach is akin to not putting all your eggs in one basket. By diversifying, you cushion yourself against the potential fall of any single investment, while also positioning yourself to benefit from multiple sources of return. While compound interest can be a powerful ally in your wealth-building journey, it's important to know that it's not a get-rich-quick scheme. Rather, it's a long-term strategy that requires patience, discipline, and smart decision-making. Picture it as a marathon, not a sprint. The goal is not to reach the finish line as quickly as possible, but to maintain a steady pace and complete the race. In conclusion, harnessing the power of compound interest can be a game changer in your financial journey. But like any game, it requires strategy and an understanding of the rules. Remember, compound interest is a tool in your financial toolbox, not the toolbox itself. Use it wisely, balancing its risks and rewards, and you'll be well on your way to building wealth over time. As the old saying goes, it's not about the money you make, but the money you keep. If you enjoyed from this video, don't forget to like and subscribe to our channel. Thanks for watching.